This is the Asia Trade. I'm Shery in Tokyo. The top stories this hour. Volatility gripping global markets ahead of President Trump's rollout of reciprocal tariffs. The S&P 500 reversing losses, but still posting its worst month and quarter since 2022. French far-right leader Marine Le Pen convicted of embezzlement and banned from the next presidential race, threatening fresh turmoil in the country. And New Zealand expecting red-hot interest in its revamped Golden Visa program amid rising geopolitical tensions. We'll speak with Immigration Minister Erica Stanford. This is a picture across Asia right now in the staggered open in Australia. Of course, there's RBA decision day. Not really a lot of fireworks expected today. We're expecting the central bank to hold rates steady. But Nikkei futures to the downside, 0.2% already. The index has fallen into correction territory as we're seeing a stronger Japanese yen below that 150 level against the U.S. dollar. Plenty of data from Japan today, including jobs data, not to mention the Bank of Japan's Tankan business survey as well. We continue to follow what's happening in the U.S. because we have heard more about the reciprocal tariffs coming from President Trump. President Trump talking about country-based tariffs, no exemptions at this time, according to the White House. Not surprising, we have seen global stocks really take a tumble. Take a look at how U.S. futures are setting up right now. We have seen the Treasury rally, European bond rally as well. We have seen more instability, perhaps, coming from the French government, as we've heard that Marine Le Pen was convicted of embezzlement. Not a lot of market reaction on that because already we had seen that sell-off on French assets given all of the tariff news. President Trump's tariffs are dismantling the post-war global trading system that the U.S. helped build. Really, his plans have sparked fears of a U.S. recession and a global economic slowdown. This is what he had to say about what those tariffs might look like.
They're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
These tariffs are the focus of today's Big Take. Senior writer for economics, Sean Donlan, joins us now for more on this. So, Sean, I mean, we have been expecting these reciprocal tariffs. We're getting some details, but not exactly what they might look like. What do we know at this point?
Look, we still don't know the details, right? We know they're coming. We know that in the next 48 hours, we're going to know more. The White House today saying the president would announce these tariffs on Wednesday in a Rose Garden press conference, which tells you that he's going to put a lot of pomp and circumstance into this announcement. But we really don't know the details. At this point, he has said in the last few days that these tariffs will apply to all countries. As you heard just there, he said that they will be relatively kind. And the key point there is relatively. He's talking about what the U.S. perceives on the other side of the equation, the trade barriers that his aides have calculated as they try to put together these reciprocal tariffs. So we may get something that comes below that level. But, you know, we're still setting up for what in trade terms and in tariff terms and in terms of the economic consequences is likely to be a pretty monumental event on Wednesday.
Yeah, a monumental event that perhaps we haven't seen in decades. Perhaps the 1930s tariffs could be comparable. What have we learned since then?
Look, I think what we are looking at in terms of size and scope, and my colleagues at Bloomberg Economics have done some fantastic work calculating the potential impact, is that the tariffs that Donald Trump is contemplating now appear likely to be bigger than the 1930s Smoot-Hawley tariffs, which came at the time of the Great Depression, helped prolong the Great Depression, set off global trade wars, and a couple of years of economic misery around the world. And look, if that's what we're going to get this time around, there's going to be economic consequences. The U.S. is in a different position than it was in 1929 and 1930 when the Great Depression had already started here. Relatively, the U.S. economy today is in pretty good shape, although we've had a lot of fears about a slowdown, about a recession being prompted by these tariffs. So perhaps it can weather this shock better. But look, we are looking at potentially a historic shock in these tariffs, and that is just based on the numbers and the calculations, the sorts of calculations that we know folks in the administration are doing now.
This is what President Trump had to say when asked about allies potentially really banding against the U.S. and cooperating amongst themselves. Take a listen.
Are you concerned that this move, the tariffs this week, could push some of the United States' closest allies to work with China?
No, I'm not worried about it. I'm not worried about it. Yeah.
Mr. President, can I ask you
I think they have a chance of doing better, actually, with the tariffs. It can actually help them in a certain way. And I think a lot of them will drop their tariffs because, they've been unfairly tariffing the United States for years.
I mean, the geopolitical backdrop was very different in the 1930s, right? Have we learned anything about what the rest of the world does if the U.S. continues this very protectionist policy?
Well, look, we're likely to see probably a very similar pattern to what we saw in 1930 when other countries retaliated against the United States, imposed their own tariffs. We had boycotts of American cars in Italy and Argentina and Brazil. We are already seeing the same behavior. In Canada, they're taking American whiskey off the shelves. In Europe, they've been working on a whole list of new tariffs to put in place. We know other economies are doing the same. So we're not going to see a peace in our time as a result of these tariffs. I think what we're likely to see is retaliation. Let's see how far it goes. Let's see whether you get multiple rounds of escalation and tariffs, and that would do incredible economic damage. Or let's see whether, as President Trump has signaled a number of times, he can cut some deals with some big economies that leads them to lower their tariffs. And that would be the best case scenario here. But even on the way to that, you are likely to have turmoil, both in markets, in terms of the economy, and an extension of the uncertainty that we've heard so many traders and CEOs complaining about in recent months.
Sean, what's left in the U.S. arsenal? Because, of course, we are expecting reciprocal tariffs. We've already seen tariffs on Canada, Mexico, China, automobile, steel. We've heard him talk about pharmaceuticals, not to mention copper as well. So what's next?
Right. So Wednesday is not going to be the end of this, right? We know that the auto tariffs that were announced last week take effect on April 3rd, the day after this big announcement, which is a signal that perhaps we'll get some other major reciprocal, at least a tranche of the reciprocal tariffs taking effect on that day. The president has talked about pharmaceutical tariffs. That's something that's very likely to come down the pike. Tariffs on copper, other potential sectoral tariffs on semiconductors, tariffs potentially aimed at things like digital services taxes that could come down the line. It's fair to say that the tariffs aren't going to end on Wednesday.
Bloomberg senior writer for economics Sean Donnan there joining us with the big take for today, everything on tariffs. And we've heard President Trump also giving his comments and perhaps support for French far-right leader Marine Le Pen. This is a very domestic news that might have some European and broader global repercussions. She's been banned from running for elected office, risking a surge in anti-establishment sentiment that could undermine efforts to stabilize the country's finances. Le Pen plans to appeal her conviction for embezzlement, calling the court ruling a political decision.
I think the judges got it wrong. I think they chose to ignore all of the explanations that were given because in the very first hours of this trial, I had understood that the court was biased against us. I did not think that the magistrates would go this far against our democratic process and interfere this much with the choice of the French. Let's be clear, I have been silenced, but it's the voice of millions of French people that have been silenced as we speak tonight.
Let's bring in Bloomberg opinion columnist John Authers. John, we saw a little bit of a reaction in French assets. They were down, but of course there was the tariff news as well. How significant is this latest developments in French politics?
Well, in the longer term for France, it could be very significant. We've all lived through what happened after the various prosecutions of Donald Trump. The thought of how history might have been very different indeed if he had actually been impeached 4 years ago in the Senate. So this is profoundly relevant to the way that the French politics is going to develop. It's probable, as far as I can see from here, that this will ultimately help the Front National, the Rassemblement National, as it's now called, Marine Le Pen's party, even if it doesn't help her, because the sense of martyrdom, the sense that you are being picked on, can actually be a very useful political rallying point. In combination with her dad, there has been a Le Pen running for president for many decades now in France, and she is in some ways more of a figure of the past. She does have a very dynamic deputy, Jordan Bardella, who is, I find it a little alarming that he's only 29. Does make me feel very old, but he's obviously a much more dynamic figure who might now have 2 years to be built up. So ultimately, this probably somewhat increases the chance that we do get a far-right French president in another 2 years' time. Although you do sort of wonder where the world will be by then anyway. I think it's had less of an impact than you would have expected on the market, simply because, as you were saying in the intro, there's so many other things going on and so many other reasons to be nervous about French assets. And this, the next French presidential election isn't for another 2 years. So this is a risk that's still quite a long way down the pike, given that we're all worried about Liberation Day in 2 days from Trump. So,
right, quote Liberation Day.
Yes, yeah.
But John, let me just ask you about what the significance and implications are for France's public finances with the overlay that we have a change in stance from Germany as well, and that's really given some new gyrations for the European bond markets as well.
Ultimately, this goes through the lens of politics. I certainly tend to agree that this might make it more likely that Le Pen's party tries to bring down the current, very wobbly government, which is trying to push through some kind of budget that reconciles all the various aims that they currently have. That will be very difficult, and as I guess not unreasonably, the Rassemblement considers this to be a provocation. They're less likely to help than they were before. I think with the amount of extra give coming from Germany and with the sense of greater European cohesion, or more of a sense that Europe has to hang together, that's been caused, I guess, particularly by the J.D. Vance speech in Munich, which really caused shockwaves across Europe. Geopolitically, that probably makes this slightly less sensitive. There's no way France is leaving the Eurozone, and they will probably be given more leeway by other European capitals than they would have been before. Again, that's a preliminary judgment. You see the headline, and it's obviously very, very shocking when the person who's leading the polls is barred from running. That is a very shocking event, and it have unexpected consequences. But I don't at this point think that it's going to be too concerning or too much worse news than we already had for French public finances.
Bloomberg opinion columnist John Authers there with the latest on European politics and, of course, the implications for the rest of the world and markets as well. Coming up on the Asia trade, Moneta telling us what they think are the biggest risks facing the market. New Zealand's immigration minister also joining us to discuss the country's new golden visa rules. Plus, we'll look at the key issues in Australia's federal election with the University of Sydney. This is Bloomberg. Take a look at how U.S. futures are trading after the S&P 500 saw its worst 3 months compared to the rest of the world in decades. We saw a little bit of a bump in the last trading session, but still defensive groups outperformed. Suffice it to say that this is the first quarter in 5 years that bonds have outperformed U.S. equities, and you continue to see the downside in the Asian session for U.S. futures at the moment. Joining us now is Aoifinn Devitt, Chief Global Market Strategist at Moneta. Aoifinn, good to have you with us. I mean, how much will the Wednesday tariffs really set the tone for the markets for the next few months?
I'd say we can't really look out the next few months. I think, as your previous guests have suggested, we are really pulling in our prediction factor in terms of what we can say to our clients. We are working very much in the short term. We know that the recent tariff news and noise has been very much short term. There have been reversals. I'd say there is a lot of trepidation around this Liberation Day, simply because we've actually had already quite a lot of bad news to digest, the automakers being the latest round of that. So we are working with our clients. We're digesting a very nasty first quarter in U.S. equity markets, looking at what that might mean for predictions going forward, and really just looking to see what Wednesday has to bring us.
Does that mean that you're veering away from the U.S. right now?
What we're doing is we're reinforcing our global allocations, which have always been in place, but have been, over recent years, quite difficult to defend. Anything that was non-US exposure was a challenge for our clients. It wasn't performing well. It was losing in terms of local currency. And it was difficult to justify when all we could talk about was American exceptionalism. We stood the course, and we basically stuck to our global diversification mantra. And but we were still looking for whether that should be re-underwritten. Now we're glad that we did. We actually are reinforced in our positive view on non-US equities. We are encouraging our clients to stay the course in terms of diversification there, but also in terms of diversification across the cap spectrum. Nobody was overly concentrated in the Mag 7 anyway, but now we're looking for where the pockets of value are in the mid and small cap sectors.
When you say non-U.S., are you veering more towards emerging markets, which already saw the worst day in over a month or so, given the risk of sentiment around the world, or more towards, say, Europe, where the expectation is for more rate cuts and for more spending as well?
Yes, we probably are looking more at developed markets, less than emerging markets. That has been, as I mentioned, we've had to defend our non-US holdings over the last number of years. Emerging markets have been particularly hard to defend. The risk reward really was not there, and we did see the risk mounting. We very much saw the risk mounting in terms of some of the regulatory risk, some of the political risk, and geopolitical uncertainty. So I would say, at least for US investors, European investors have a slightly more open-minded approach, I think, to emerging markets at this time. But US investors have been somewhat leery of emerging markets. I don't see that changing right now, especially as you noted, they seem to be quite levered to this trade uncertainty and equally the volatility that's coursing through all global markets.
Aoifinn, when you talk about smaller caps and when you talk about perhaps some of those value names as well, are you concerned at all about the potential that the U.S. could actually perhaps not head into a recession, but see more consumption being hit?
Definitely, that's a huge, probably the biggest risk we think right now is the consumer not feeling anywhere near as optimistic as they have. And we're talking about long term and short term. Over the long term, the consumer sentiment indicators where it was about 2022. So it's not as low as it has been in the past. But when we look at a short term indicator, that's the lowest it's been in 12 years. So looking at into the short term in terms of income, in terms of job security, the consumer is not at all sanguine. So that could be a factor across all equity markets. What we think, though, is that SMID, and I'd say SMID more than small cap. Small cap has a lot of liquidity issues. It will have challenges from consumer demand. SMID is a little bit more insulated from global trade. So that gives it just that buffer against some of the tariff implications. It doesn't have the currency effect equally. And I would suggest that SMID market, sort of steady state, industrial names, some of the names that could be open to M&A from the burgeoning private equity interests, that could all be of interest, but every sector will be exposed to the consumer.
When it comes to value plays, does China factor in at all for you?
I wouldn't say for our US clients much at the moment. We obviously are always looking at China. And it was interesting to pick up President Trump's comment earlier that he's not concerned about China. I think forming alliances with other trading partners. I think the fact that he's not concerned doesn't mean that the market commentators should not be concerned and should not be playing out the game theory of what that might look like. I think we know, certainly with looking again, say at the Panama Ports deal, that there's quite a bit of political interference and oversight occurring across the board, across all geopolitical matters and trade matters at the moment. And I'd say we need to watch that very carefully. I wouldn't say we're looking at China in terms of a value play necessarily out of the US, but European clients do and have had longer exposure to China. That has looked quite interesting recently simply because it was so oversold.
And where do you stand on treasuries and the broader global bond markets, which continue to rally at this point because of these safe haven moves?
Yeah, I'd say we have not, obviously we don't expect bonds to be where our clients will see most of their growth going forward. Although in terms of cash, it's been a very nice place to park cash. It's been meaningful. Inflation numbers somewhat subdued, so the returns on cash, even in real terms, look interesting today. But we are cautious on bond markets. We've seen a lot of volatility there. We know that the interest rate movements are going to be quite divergent around the world. We don't know what the Fed has in store. We know they have some arsenal to stimulate the economy. We know the ECB most definitely does. So we are a bit conscious, though, that fixed income markets have not been necessarily believing the spin of central banks and have been very volatile recently. So while the income is interesting, we want to be wary of just the way that capital value moves around.
Aoifinn, Devitt, good to have you with us. Chief Global Market Strategist at Moneta. Of course, we have plenty to watch out for in the markets. We do have more heads on the Asia trade. This is Bloomberg. This is the Asia trade. These are the latest from the corporate front. Huawei has posted its first quarterly net loss in years after U.S. sanctions forced it to spend aggressively on R&D. The Chinese tech giant says its net loss in the December quarter stood at around $41 million. Despite this, Huawei saw gains in its smartphone business, cloud computing arm, and its core telecom unit. The rapid growth in EVs helped Huawei's smart driving solutions unit turn profitable last year. Bloomberg has learned that U.S. contract chip maker GlobalFoundries is exploring a potential merger with Taiwan's United Microelectronics Corporation. Sources say GlobalFoundries' incoming CEO has been considering options as he prepares to take the helm this month. An agreement would require approval from Chinese regulators and may involve heavy borrowing or stock dilution. AI startup Builder.ai has lowered the sales figures provided to investors and hired auditors to examine their last 2 years of accounts. The company reduced revenue estimates for the second half of 2024 by about 25%. The company, backed by Microsoft and Qatar State Fund, confirmed the adjustment to Bloomberg after several former employees alleged sales figures were inflated. We continue to watch those emerging market stocks, which fell the most in about a month. Do watch out for Taiwan equities at the open. This is Bloomberg. We start you off with breaking news out of Japan. The February jobless rate coming in at 2.4%. The estimate was for 2.5%, so it's also lower from the previous month in January. Also, when it comes to the job-to-applicant ratio, though, that's missed estimates, and it's actually coming in at 124 jobs offered for every 100 applicants. So 1.24, and that number has come down from 1.26 in the month of January. Still, overall, we continue to see a very tight labor market in Japan. We have seen underlying wage momentum building, base pay increases also picking up. We'll get a feeling of how Japan's corporations are feeling in a few minutes. In about 20 minutes, we do get the Bank of Japan's Tankan business survey as well. The Japanese yen right now weakening slightly and past that 150 level against the U.S. dollar. Nikkei futures pointing to the upside after actually falling into correction territory in the previous session. Of course, we continue to see a relatively stronger Japanese yen, given, of course, all of the tariff news. We do have automakers being hit in Japan, so we'll be watching that sector very closely. Let's take a look at Japan's economic data and what it really means for the BOJ and the broader markets, and bring in MLife strategist Mark Cranfield. Mark, so this jobs numbers still seems pretty resilient. What are the implications for the Bank of Japan and the tightening path?
Not too much, really, when you consider that right now the Bank of Japan has to get its head around the tariffs, which will be coming from President Trump sometime this week. That is a much bigger impact on Japan. The auto sector is huge, very important to the Japanese economy, and the Bank of Japan will certainly have to take it into account in how they form policy. It's one of the reasons why the market is not pricing for anything until September in terms of an interest rate change from the Bank of Japan, even though, as you say, the underlying economy looks to be doing pretty good. We'll probably get more confirmation from those Tenkan numbers. And if you look at the way wage hikes have been going up pretty well in Japan, food inflation is still very high. Certainly everything is falling into place for the Bank of Japan to raise interest rates. And yet you have to take into account that the economy could well be hit by tariffs against Japan. And also Japan is going to be facing elections in July as well. So the near-term picture is much more difficult for the Bank of Japan to make a decision. Traders know that. That's why they're pricing for a delay at the moment, only September, for the next change in policy.
And you're seeing that in the JGB market as well. I mean, we've seen this incredible global bond rally given all of those safe haven moves, given, of course, the incoming tariffs. And at the same time, already Japanese JGB yields were at multi-decade highs. Are we seeing a rethinking right now?
Well, actually, it's more to do with the curve. You may well see a little bit of support in the shorter end of the market. We saw that yesterday. The 2-year auction went off extremely well in Japan, very well supported. But if you see overnight, the Bank of Japan announced its purchases, the plan for the next quarter ahead. And the key change was in the 10 to 25 duration. The Bank of Japan is going to reduce purchases of Japanese bonds in that. So clearly the curve is going to steepen. The Bank of Japan, probably to help support the banks, to make sure that the banks still have a decent cushion, they're going to encourage an even steeper yield curve at the very long end. By reducing the purchase. First time in a year they've done so. Now, what that'll mean as well is that the spread between long-end JGBs and US Treasuries will probably narrow further. Now, that is a relative support to the yen. It's a more of a slow burn process rather than something that's more immediate. If it was a short-term yields, it would have a much bigger impact. But it is a support for the yen over the medium term. Now, that also helps the Bank of Japan, because the Bank of Japan wouldn't want to change policy when the yen is going through a weak period. That's why they got so much criticism last year. They increased interest rates in July. Immediately we had that collapse in dollar yen as all the trades were unwound there. It sent shockwaves through the stock market as well. Bank of Japan got itself into a bit of hot and bother with the Japanese politicians. It's much easier for the Bank of Japan to tighten policy when dollar yen is on a downtrend, which we did see in January this year. So it will certainly help to give the yen some support. Of course, the flip side of that is what happens with the US dollar as tariffs come into play. But it looks as though US exceptionalism is being eroded, and that generally will be a negative for the US dollar.
Yeah, I mean, that's been really interesting. The Japanese yen really range-bound despite all of this global risk-off sentiment. MLife strategist Mark Cranfield there with the latest on Japan. We also had Parliament passing that initial budget. After multiple revisions, lawmakers approved the spending plan amounting to 115 trillion yen, or over $770 billion, just a day before the start of the new fiscal year. Prime Minister Shigeru Ishiba has been forced to negotiate with smaller opposition parties to pass the budget, at times conceding ground to their requests. And of course, a big part of the global tariff news is the impact on Japan as well when it comes to car makers. Bloomberg has learned that U.S. automakers are also lobbying the Trump administration to exclude low-cost car parts from tariffs. Earlier, Trump told reporters that he wants to offer tax deductions on American-made cars.
If you buy a car that was built in the USA, you get a deduction on interest. It's a big deduction for people that really aren't used to deductions, frankly.
For more, let's bring in auto reporter Keith Naughton. Keith, what do we know about what automakers lobbyists are trying to get out of the Trump administration when it comes to these concessions?
Yeah, so what the automakers are doing is they are lobbying hard, making a sort of last-ditch effort to try and get a break on the tariffs as it applies to auto parts. They're ready to pay the tariffs on fully built automobiles, but if they have to pay a tariff on each of the thousands of parts that make up an automobile, they say that'll just break the bank.
What's this thing that we're hearing about tax deductions on the auto interest?
That is something the Trump administration is shooting for. It is a way to give consumers something of a financial break. It's in anticipation that the tariffs will drive up prices. So the administration is trying to say they can counterbalance that by allowing you to write off your auto loans on your taxes.
But given how much the U.S. really imports from overseas, what are we expecting the hit to be on consumers and the broader U.S. economy?
Yeah, the estimates on price increases range from about $4,000 a car to $12,000 a car. It's expected to be quite substantial, which will slow down auto sales and also could lower auto employment in the United States. These are very large tariffs, and as you say, the U.S. is the largest importing market in the world. Half the market, 8 million vehicles, was imports last year.
So we talked about the impact on U.S. automakers. What about the impact on foreign automakers? We have many here in Japan that export to the United States.
Absolutely, and chief among them is Toyota. They are Japan's largest exporter of cars to the United States. Last year, they exported 550,000 cars from Japan to the United States. Honda, by contrast, builds all its cars in North America that it sells in the United States. So Toyota is particularly exposed to these tariffs with its Japanese production.
Do we have any idea right now of the ramifications for parts suppliers and the broader auto ecosystem?
Yeah, it'll just get more painful as you go down the supply chain, and this could really hurt especially Tier 2 and Tier 3 suppliers. They just don't have much margin for error whatsoever, not like the automakers themselves do, but the suppliers have even less, and this could really threaten their futures.
Bloomberg's Keith Naughton, good to have you with us, and insights on automakers and, of course, what the impact will be in the U.S. and other countries as well. We have more ahead on the Asia trade. This is Bloomberg. Take a look at the early session in Australian markets, with the ASX 200 gaining 0.8% after already seeing the worst day in 3 weeks, of course, as we set up for those tariffs coming from the U.S. Reciprocal tariffs, according to President Trump, on all countries. The Aussie dollar holding steady at the moment at that 62 U.S. cents level. We're watching the global bond space as well. The 10-year yield in Australia holding at that 4.42 level as that global bond rally continues, and these moves and flows to safe havens continue ahead of the tariff news. And of course, it's a big day in Australia. Australia's central bank expected to keep interest rates unchanged on Tuesday amid a federal election campaign and the uncertain economic impact of Trump's tariffs. For more, let's bring in economy reporter Swati Pandey. Swati, I said big day, but really no real fireworks expected, at least for today, from the RBA.
That's right. After the RBA cut interest rates in February, it is expected to stand pat today. I think the most interesting part will be the press conference that Governor Michelle Bullock holds. There will be a lot of questions around the impact of tariff, around elections, government spending, and just trying to get a handle on what the RBA is thinking, how the economy is tracking, and whether May is going to be a rate cut.
We just got Australian home prices climbing to a fresh high. How big of a risk is that in the RBA's calculation?
So look, the RBA always says that it does not target housing prices, but that is a reflection of consumer sentiment. That also does feed into inflation. Housing inflation has been elevated, so it is a concern, especially at a time when the RBA is not projecting inflation returning to the midpoint of its target over the next couple of years even. So it definitely does not want a situation where it is cutting interest rates and that is sparking a housing bubble. This is also an election issue. Housing is one of the key election priorities. People are really disgruntled because of unavailability of good housing or new home buyers or young people not being able to afford their first homes.
What about external factors that the RBA really can't control, such as the vote coming up in Australia May 3rd, not to mention, of course, these reciprocal tariffs that could also target Australia?
The RBA and Governor Michelle Bullock has been very artfully saying that there are a lot of uncertainties that they are dealing with at the moment, and that has been one of the reasons why the RBA has sounded more hawkish than several other central banks, and that is one of the reasons they are not giving any forward guidance as well. So the way for them to tackle this uncertainty is to just stay neutral, not provide any forward guidance, and just keep their cards very close to their chest.
Bloomberg's Friday Pandey there with a preview of what to expect from the RBA later today. Morgan Stanley's chief U.S. equity strategist thinks investors should brace for even more disruption coming from the White House. Mike Wilson told us President Trump's policy changes so far have all been growth negative.
Everybody's looking for like a final piece here. This is gonna take time, you know, and not unlike a lot of the other policies that have come out this year. Like this is what we kind of signed up for, right? I don't think what the president has done has really been surprising. All of the policy changes so far have been growth negative, and that, you know, we've likened this to a new CEO coming in, right? They want to restructure the company. They're restructuring the company. They're going to kitchen sink it. And then they're going to try to make, you know, their plan work for next year. So this is going to take some time. And, you know, this level that we're at now is critical from a market standpoint, not so much from the administration standpoint. I think that's also something to acknowledge.
It's also very on brand for Trump to take a maximalist approach in the very beginning. But how messy could it be if he comes in with this maximalist, aggressive approach, and then we have retaliation from trading partners? Well,
look, it's the NAFTA. I'm sort of like, you know, it's the best alternative to a negotiated agreement, and the BATNA, and that is classic negotiating tactic. You come in and way over here to the right with the hope of kind of settling in the middle. So I don't think that's unusual either. The response from trade partners is that means they're engaging. Okay, so that's how you get people to engage in your discussion. You come out with a big splash. They have to come to the table and negotiations begin. We're not even at the table yet. Okay, so that's why this is going to be very uncertain for a period of time.
I think some countries think that they are at the table because they sent a few representatives here the past few weeks, but I agree with you. It really hasn't started. So what do you do if you're an investor?
Well, you've done what we've sort of done. You avoid the areas that are going to be most affected. Consumer discretionary goods, and that area has been hit the hardest, so maybe that's getting a little bit extreme. I would say, you know, defensively positioned, high quality, that's been our core portfolio. Now, we've made some trading calls lately that would have gone against that. Some of those worked, some of those didn't work. But I think at this point, you want to be up the quality curve. You want to be in businesses that can kind of mitigate some of these concerns. You have pricing power. You have the ability to kind of move production around. You can take inventory on to kind of buffer this for 60 or 90 days, which we've seen all of those mitigation strategies, something we wrote about in our note today. So those are the kind of companies we want to own in this period of time. I do believe there will be a clearing event at some point this year, but we're not there yet.
Morgan Stanley chief U.S. equity strategist Mike Wilson speaking with Bloomberg Surveillance. Time now for morning calls ahead of the Asian trading day, as we have some more comments coming from Goldman Sachs' David Kostin as well, cutting his S&P 500 target for a second time this month due to increased recession risk and tariff-related uncertainty. He expects the benchmark to end the year around 5,700 points versus his previous estimate of 6,200. Kostin warns that the valuations could decline further if the growth outlook and investor confidence get worse. Wells Fargo also predicting the U.S. dollar will be a market winner due to Trump's trade war. Its currency strategist expecting that the dollar will rise between 1.5% and 11%, depending on the level of U.S. tariffs and the other countries' responses. The predicted rise is due to weakened demand for overseas goods, and the Fed also keeping interest rates elevated. We, in fact, saw the dollar seeing a little bit support in the overnight session, but we have to be mindful that we haven't really seen that big rally as we've seen in the past on safe havens during market sell-off. Instead, we've actually seen it sink against other currencies. We have seen some discussions whether overseas governments will accelerate efforts to lessen their reliance on the dollar. We continue to watch the offshore yuan holding at that 726 level. The Japanese yen also 149.98 would be in really range bound when it comes to the Japanese currency. The euro also holding steady. We do have more political risk coming from the French government with Marine Le Pen convicted of embezzlement in France. We have more ahead on the Asia trade. This is Bloomberg. We have breaking news out of Japan. We have the Bank of Japan's Tankan survey for large manufacturers, the number coming in for the first quarter at 12, which is slightly below the previous quarter, but in line with expectations. For the non-manufacturing sector, we have 28, again below what economists had expected for the first quarter, but staying in line with the previous data that came in the last quarter of 2024. What's interesting right now is the yen outlook of all Japanese enterprises, now seeing it at that 147 level for fiscal year 2025. This is, of course, slightly stronger than the current level of around 150. We had been expecting these numbers to show a little bit of uncertainty coming from U.S. tariffs and perhaps that manufacturer confidence being hurt a little bit. And we do have large manufacturers' outlook also disappointing to the downside of 12. Really coming in lower than the previous quarter. When it comes to the non-manufacturing sector, though, we did get some tourism boom because of the weaker yen, and that has really bolstered the service sector and the non-manufacturing outlook coming in at the same level as in the previous quarter of that 28 number. Now, other stories that we're watching out of Japan, Renault and Nissan have agreed to further loosen their long-term alliance, giving them more financial flexibility. The two companies will reduce their cross-ownership level to 10% from 15%, allowing Nissan to raise some $750 million by selling more of its stake. Renault will also take over the alliance's India joint venture. Tokyo Gas has reportedly decided to buy part of a shale gas development in Texas from Chevron. The Nikkei reports a deal is estimated at tens of billions of yen and is expected as early as this month. Tokyo Gas will use the natural gas it extracts from the development to trade on the market, as well as supply power plants and other customers. Nintendo's long-awaited new console, the Switch 2, is set to be unveiled on Wednesday. It's the Japanese gaming giant's first major hardware release in more than 8 years. Let's bring in Bloomberg's Japan stock reporter Alice French. Alice, so what should the market be looking at in this unveiling of the Switch 2? Do you have the Switch 2? Do you have the
No,
first
I'm afraid
console?
I don't. I don't have secret access, though I'd love to. No, well, like you say, fans and the market have been waiting over 8 years for this, so the stakes are pretty high. And as well as the hardware, the market will be looking at the software compatibility of this device, right? So whether or not the console is going to be compatible, for example, with new games that were released for the PlayStation 5, Sony's latest console. So whether or not users will be able to access games that they can't play on their previous Switch, because that will boost demand for, a reason to upgrade, right? Another thing, of course, will be the price. So there are a lot of predictions out there. Some people are saying $450 to $500 seems to be the range. That's quite a lot higher than the original Switch, and investors will be looking at whether that price is justified, right?
I'm looking forward to it. I mean, I played the Switch for a while. It's right now shelved somewhere in my house. But we have seen really Nintendo stock prices, surge in the past year, right? Because of these expectations. So could they disappoint?
Right. Well, there's always that risk, right? Like you say, it's surged to new highs on anticipation for this console. And we're seeing the valuation at sort of 7-year highs, which does mean that it could be vulnerable to disappointment. We saw in mid-January, Nintendo released this sort of teaser video for the Switch, which gave us a little glimpse at what it might be like. And on that day, actually, the share price really did dip and kind of suffered. And there is an element of perhaps kind of buying the rumor and selling the news when it comes to Nintendo. And so the expectations are very high. But of course, the next hurdle for them will be the sales. Can they sell out? People are expecting that they will sell out kind of the initial inventory, but how long will those sales continue, and how much can it help to boost earnings, which have really kind of suffered? Sales have suffered as the Switch has aged,
Not to mention that we have the tariff risk always, right? Are they affected?
Yeah, so look, the Switch 2 and the Switch, they sell a lot in the US. People expecting around 40% of Switch 2 sales might come from the US. And of course, there are risks that tariffs could push up the price of the Switch 2. And as I mentioned before, it's already pretty high. So that risk is there. Having said that, Nintendo also obviously makes software, right? They make Mario Kart games, they make Pokemon games. They have that kind of IP to fall back on, which is safe for the most part from tariff risks. And Nintendo has been really building out that IP part of their business. We had the Mario Brothers movie a couple of years ago that did really well, and the shares performed really well on that too. So, Nintendo, there's the risk, but there's also the fallback too.
Yeah, I bought mine at Best Buy in the US, so we will be watching the repercussions coming from the US tariffs, of course. Bloomberg's Japan stock reporter Alice French, as we head towards the Japan and Korea opens as well. Of course, we might still feel a little bit of risk off, although futures right now are pointing to the upside ahead of those reciprocal U.S. tariffs to be announced. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens and bracing for those reciprocal tariffs coming from the U.S. on Wednesday. President Trump saying that it will be on all countries and that he's not worried that tariffs will push allies toward China. But of course, we have already seen the global market reaction with that massive sell-off.
Yeah, and that does look like that sort of risk sentiment, the aversion is set to continue, right? Really challenging time for global central banks as well. We've got an RBA decision today, Shery. Not just these geopolitical and global trade concerns, but also, of course, an election year to contend with. It's a pretty fine balancing act for the RBA.
It's a very difficult environment when it comes to central bankers. We continue to watch the Bank of Japan as well and JGB yields because we have seen them really fall to multi-decade lows given multi-decade highs given the expectations of more tightening coming from the Bank of Japan. But at the same time, of course, we are now seeing these global risks that might delay those rate hikes from the BOJ. So investors having to really reassess and rethink the strategy in Japanese assets as the Nikkei now rebounds a little bit in the early session after falling into correction territory in the previous session. The topic's also gaining 1%. We'll be watching those automakers that have been hit by the tariffs already. The yen holding that 150 level. We have seen a pretty range bound here in Japan for the Japanese currency, but it's the 10-year yield at that 150 level that we'll be watching closely given the expectations of rate hikes. We have seen the jobless rate coming in at 2.4%, as well the Tankan survey, also a little bit of mixed confidence among large and manufacturers and non-manufacturers. Take a look at how the Kospi is coming online. It fell to the lowest level since February. We know that the tariffs will hit South Korea, and we're getting the breaking numbers for exports out of South Korea. March rising 3.1%, which is disappointing to the downside. The expectation was for 5%. Imports also rising 2.3% year on year, leaving a trade surplus of $4.98 billion, slightly below what economists had expected. We had expected a lot of front loading of shipments given, of course, the tariff risk and the tariffs kicking in already this week, Haidi.
Yeah, Shery, take a look at what an hour into the start of trading here in Australia. And of course, as I mentioned, it is RBA decision day. No major surprises expected from the RBA there. They are expected to keep the cash rate at 4.1% today. But the sort of trajectory forward is a little bit more uncertain. We're seeing some modest gains, actually, really supported here by some of the mining companies and financial shares as well, just tracking that rebound that we saw in the S&P 500. But that sort of increasingly volatile picture is still very much at the fore. Aussie dollar a little bit on the back foot, 62.38 there, and watching treasuries, which of course we saw that pairing of the haven bid that has been such a strong standout play in this sort of environment. But of course, you couldn't be sort of surprised for that to come back as we get those tariff threats continuing to build throughout the course of this week. We're also watching oil as well. Crude is really holding on to its pretty hefty advance. That threat of secondary sanctions from President Trump, tariffs still very much in focus, despite, of course, the broader global demand picture still looking pretty muted, and the threat of course, more supply coming online from OPEC Plus as well in the months to come. Let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage. And Garf, a slightly better day for risk sentiment, but you know, I thought it was interesting. And in fact, I was reading John Authers' piece about what replaces this kind of US exceptionalism story, right? The narrative for investors seems very unclear right now.
Well, yes, a big part of that, of course, is the extreme level of unclarity, if I can use that word. Why not? That's been emanating from from the White House, from the US, and Liberation Day, as it has been touted, tomorrow when the reciprocal tariffs come in. It's already clear that we still won't have a lot of clarity once that actually occurs, because apparently there will be country tariffs, but there won't be sectoral tariffs then. Trump seems to change his mind every hour or so about how severe the tariffs might be. So that creates a lot of uncertainty. But the other thing that's going on is that investors are waking up to the idea that one of the major impacts of all of this is a weaker outlook for the US economy. Now, yes, that undercuts the US exceptionalism theme. The problem is that for a lot of the world, a weaker American economy is a burden, because the US is the world's largest economy. When it slows down, that is going to hurt a lot of economies, unless there are particular economies, and there aren't too many out there at the moment, which have a reason to power ahead. China is one potential there, because it's already gone through a nasty downturn, and it's trying to reboot its economy to get growth going again, and to get growth going in a slightly different way than it was before. Now, the jury's still very much out about whether it can achieve that or not. But that's part of why China has been something that investors turn to. And again, then looming over China is the concern, well, what happens if Trump doesn't get the April 5 TikTok deal that he wants to, and he becomes unhappy about what's going on there? He has actually already placed a fair bit in the way of tariffs on China, and he's got other irons in the fire there, so that's a risk there. And again, Europe, that's been seen as an alternative because they're moving to boost defence spending, but there are growing concerns that they might struggle to actually, carry out that defence spending without driving borrowing costs up too far. So yes, I think there's going to be an end to American exceptionalism. What takes its place is extremely unclear, because much like when you get people talking about the potential for something other than the dollar becoming the reserve currency, sounds like a good idea. Then you look at the alternatives and go, well, I'm not sure there is an alternative.
How difficult is the environment for central bankers around the world as we head towards the RBA rate decision today as well?
Well, it's definitely become a lot more complicated than it was even a few months ago. We came into the end of last year looking like mostly central banks, developed market central banks, excluding Japan, could be fairly certain that they'd done a good job in tamping down inflation, that they were heading towards their targets that they could start cutting rates, and the only question was, how fast do they want to be about that? There was a tendency towards caution. The memories of being behind the curve on the 2022 inflation takeoff are still pretty raw for a lot of central bankers. So there was a reluctance to go too far, too fast. Now we've got a situation where what's going on with tariffs makes the inflation look potentially sticky again, and yet growth looks potentially slow. So you've got a lot of factors pushing against one another, and central banks wondering, can we afford to cut rates, but then can we afford to not cut rates? So that makes for a very tough outlook for central banks.
Garfield Reynolds, who leads our Markets Live Asia coverage there. And just continuing on the tariff news, just as Garfield mentioned earlier, President Trump telling reporters in the Oval Office that it's possible tariff relief for China could be linked to a TikTok deal. Take a listen.
Is the TikTok deal, the negotiations now, tied to a bigger tariff deal with China?
No, but it could be. I mean, I've used tariffs for lots of different reasons, but I could see, 1 point in tariffs with China, big country, would be probably worth more than all of TikTok, as valuable as TikTok is. It's big stuff. So there's a great example. That's a great question, actually. I'm a very flexible person. I could use that for that.
Let's bring in Bloomberg government editor John Herskovits here in Tokyo. And John, we've talked about the immediate effects of tariffs, right, on sectors like automakers, steel, but also on specific countries. Now, reciprocal tariffs. How difficult is it to really calculate the economic impact overall of everything that President Trump is doing?
Sure. We don't really know what's going to happen. A lot of these things with the Trump tariffs, it's all last minute. There's lobbying going on. What will actually come out on April 2nd is still up in the air. But Bloomberg Economics did a maximalist approach to this. And if the tariffs are along those lines, they're looking at like a 4% hit to GDP for the U.S., lopping off $1 trillion in output. And then you have the other tariffs that are going into effect, the auto tariffs. For the consumer, this will mean several $1,000s per car in the U.S., and it raises prices at a time when consumer confidence is waning in the U.S. So you have the steel, aluminum tariffs adding costs to production, you have the auto tariffs coming in, and this third set of tariffs, all of which could really deliver, or expect to deliver, a really hard hit to the economy in the U.S. and globally.
John, what can governments do? What are they doing to potentially prepare?
Yeah, you're seeing governments in Europe, Asia, around the world. They're looking to find out what they need to do, if they're going to do retribution or not, how they're going to prepare for this. You're seeing some odd partnerships as well. India and Canada are looking to cool a diplomatic fracas that really hurt relations and perhaps band together with regard to the tariffs. Japan, South Korea, and China have held high-level meetings over the past few days. Now, the economies of these three Asian countries is just a little bit smaller than the U.S., but you're seeing leaders in countries looking at what they can do domestically. They're looking at international partnerships. You're seeing a lot of preparation for these tariffs, and when they're finally released, we'll find out exactly how they're going to react.
Yeah, Bloomberg editor John Herskovits here with us on those tariffs and the preparation from governments and also investors. At the moment, we're seeing a little bit of a rebound when it comes to Asian markets early in the session. We have more ahead. This is Bloomberg.
Well, New Zealand says it's seeing strong interest from the US and Europe in its revamped golden visa programs amid rising geopolitical tensions. Applications opened today following an overhaul designed to make the program more appealing to affluent migrants. Changes include scrapping the English language requirement and reducing the time investors must spend in the country. Joining us now from Wellington is New Zealand's Immigration Minister, Erica Stanford. Minister, really great to have you with us. And, we wanted to dig a little bit deeper into sort of the intention and application of this new revamped program. How much interest are you seeing in it already as it gets started today?
Well, look, anecdotally so far, we've seen a huge amount of interest. I know that offshore officers have been telling us that it's been running red hot, the interest. So we are expecting today and over the coming weeks a lot of interest and a lot of applications.
A lot of the sort of high net worth individuals and the immigration story has come from China in the past, both for Australia and the likes of New Zealand, of course. But I do wonder, with a lot of the geopolitical uncertainty emanating from the Trump administration, are you seeing sort of special levels of interest from the US? We're hearing of a brain drain, for example, that is benefiting the likes of France, the UK and Canada.
Look, there's certainly been really strong interest from the American market. We had a number of investors who were down here taking a look at New Zealand a couple of months ago, and I spent time with them, and they were really excited. And these are exactly the kind of people that we are trying to attract to New Zealand by saying, hey, we're open to the world. They have incredible skill, incredible connections, a huge amount of enthusiasm to help take New Zealand businesses to the world. I mean, we have some amazing startups here in New Zealand and some great local businesses that investors are really interested in helping out. And so that American market has been very, very interested. And I know many of our immigration lawyers and agents have been up in the US in the last couple of weeks. And their feedback to me was that red hot comment, that the American market is red hot and very interested in coming to New Zealand.
How do you get the sense that we're seeing these flows into New Zealand perhaps in the future, given this moment in history right now, more geopolitical tensions around the world? Is it the type of immigrants that are trying to come to New Zealand? Is it the type of visas that they're seeking?
Look, you're right about the instability in the world at the moment. There are a lot of people around the world, especially up in Europe and in America and in Asia as well, who are looking for a country that is politically stable, that has incredible people, an abundance of natural resources, and businesses that are worthy of investing in, but also a place that is really safe and secure. But also I would add, still smack bang in the middle of the Asia-Pacific region, and so very connected to the world, but in a really stable part of the world. And so I think that's part of the attraction. But, it's not only that uncertainty around the world, it's also that migrant investors are looking for opportunities. And we have huge opportunities here in New Zealand. I mean, we are the home of Rocket Lab, for example, the second largest company in the world that launches rockets into space. We have amazingly talented people, a can-do attitude. And I think investors are looking for that as well.
What are the kind of calculations that the government has in place in terms of the economic boost, the impact on the local economy as you get how many of these immigrants through the application process and eventually settling down in New Zealand?
Look, we know that under our previous settings about 6 or 7 years ago, we used to have an investment of around $1 billion a year into New Zealand. If we could get back to that sort of $1 billion a year level of investment, I would, of course, be very happy. These are just early days, and we'll see where we get to. But certainly from the anecdotal evidence we've had so far of the interest from around the world, I'm hoping that we will get there quite quickly. But we'll just see how the next few weeks go.
Have you sort of done modelling around the short-term and longer-term economic boost that you could see as a result of this program?
We have, and we've certainly looked to the past of what happened in the past. We have tweaked the visa slightly. We are making sure that the settings are such that they are making sure that investors are really looking to that more high risk, directly investing into businesses and managed funds, more so than bonds and equities. So in the past, we did have a lot of people coming in and investing in more passive investments. The way that we've set up this new visa really is to encourage people to come and invest, as I say, directly into those Kiwi startups, Kiwi businesses, but also into managed funds as well. And of course, that has a greater level of impact. So the modelling we've done around the impact of that it has been really important, but it's interesting that the feedback we've had, again, it's just anecdotal because we haven't looked at the applications we've had in yet today. It's only day one. But the anecdotal feedback has been that investors are more interested in that higher risk category, which is much more beneficial for New Zealand. And that's why we set up the visa in such a way that it is a lot more attractive. So you don't have to spend as much time in country in order to get your permanent residence if you're going in via the higher risk. It is and it is also a lower amount of money as well. So we are initially seeing that there is a lot more interest in that sort of higher risk end, which has a greater benefit to New Zealand.
What's been the feedback so far from the broader New Zealand public? Because, of course, every time you have a large inflow of immigrants, it can cause problems in the local economy, especially when it comes to things such as pricey housing markets.
Look, sure, but for this visa, we are literally talking about a couple of hundred people a year. Very high net worth people who have incredible experience and passion and contacts around the world, but literally the amount of people that will be coming in, it pales in insignificance to the number of people we have coming in on work visas and for partnership and other categories. I mean, in relation to the OECD, for example, we know that New Zealand has a higher rate of population growth, which is 90% of that is driven by immigration. So we have and are used to quite high levels of immigration, but this visa really is only bringing in a very small number of people, but the value that those people add to our GDP and our growth is exponential.
Is there a consideration of a loosening on that home purchase ban, particularly for more expensive properties, because that was floated in the 2023 election but eventually sort of stood down?
Yes, well, I mean, as your viewers may know, we are in a three-way coalition government, and so that unwinding of the ability to, or non-ability to buy a house if you are a migrant at the moment is something that is being discussed at higher levels than me, of course. So I can't talk to that particularly today, but it is something that we are having ongoing conversations about, because we know that if we are asking investors to come to New Zealand and invest their resource, their time, their energy, and come and relocate here with their families, then the expectation should be that they have the ability to buy a home here and invite, their friends and family from around the world to come and spend time here in New Zealand with them in their home. And so it is certainly something that we are considering.
Minister, really great to have you with us. Erica Stanford, who's New Zealand's Immigration Minister. More ahead on the Asia trade. This is Bloomberg.
Take a look at how European futures are trading at the moment. After 4 sessions of losses, we're seeing Euro Stoxx 50 futures to the upside of 0.4%. All of this, of course, ahead of the tariff news expected from the White House when it comes to reciprocal tariffs on all countries. We also saw some pressure for French assets. Far-right leader Marine Le Pen has been banned from running for elected office, risking a surge in anti-establishment sentiment that could undermine efforts to stabilize the nation's finances. Le Pen plans to appeal her conviction for embezzlement, calling the court ruling a political decision.
I think the judges got it wrong. I think they chose to ignore all of the explanations that were given because in the very first hours of this trial, I had understood that the court was biased against us. I did not think that the magistrates would go this far against our democratic process and interfere this much with the choice of the French. Let's be clear, I have been silenced, but it's the voice of millions of French people that have been silenced as we speak tonight.
Let's bring in Bloomberg strategist Devitt. And David, of course, we saw the market reaction in French assets, but a lot to do really with the upcoming tariffs from the U.S. as well. When it comes to longer-term implications, though, when it comes to public finances, given the gyrations that we've already seen in broader European bonds, given the change in Germany's fiscal stance, what could we be watching out for in the next few months?
I think in the near term, so for the next few months, even though Marine Le Pen was sort of leading polls for the next 2027 election, I think you have to remember it was the 2027 election, i.e. 2 years away. And as we know in politics, a lot can certainly happen in 2 months, let alone 2 years. I think what will certainly be interesting is, assuming she cannot run, she's going to appeal. But if that does remain the case, then the National Rally could still be leading the first round. If more like Jordan Bardella, who's the party chief, you would guess he would sort of take over her position as being the front runner. But as I said, it's 2 years away. A lot can happen. And just because you're expected to win the first round doesn't mean you'll win the second round, which is the most important. That's often when there's only 2 people involved, and people sort of change their voting strategies at that time. So at the moment, while it's not positive on the budget, you'll be looking for how does the existing budget, does it get passed? What's the ramifications in the near term? At the moment, we're seeing the House is very in array as such. It's very hard to pass anything. So at the moment, the focus is on what budgets can be passed and to what degree, do they meet the EU criteria of being within so much of GDP. So I think that's what the market will be focused on in the near term when it comes to the voting side of the equation.
We saw European bond yields seeing that big move, and that, of course, passed through to treasuries as well. Does there seem to be some second guessing on what the ECB will do next month?
Yeah, I think there definitely is at the moment. The market's looking for a rate cut in April 17th, obviously about just over a couple of weeks. There's about 76% chance. And of course, some of the dovish ECB officials have said, look, if we need to kick that can down the road to the June meeting, we may need to do. I think it all depends on what does happen with these tariffs. We know President Trump will announce some tariffs tomorrow in the USA. The question then becomes, how high are those? Then it becomes, does the EU and other countries retaliate? If they retaliate, what does President Trump do then? Does he retaliate even further? So the question of really is how high and how long do these tariffs are they there for? And that, of course, is an unknown. And given that the next ECB meeting is only 2 weeks away, some ECB officials say, look, why not wait till the June meeting when we have a bit more information? So the market's looking for the rate cut, but certainly it's not guaranteed at the moment.
Affinity there with the latest on the ECB. More ahead on the Asia trade. This is Bloomberg. Take a look at what we're watching when it comes to a bit of data coming through before that RBA decision today. And when it comes to retail sales numbers, February retail sales rising 0.2% month on month, a little bit weaker than expectations of 0.3%. Of course, a little focus when it comes to Aussie households at the moment in terms of how much of a confidence boost we've gotten from the easing that we've had so far. The RBA today, of course, expected to hold rates at that cash target rate of 4.1%, but looking, of course, at a potential cut in May. The recent inflation numbers, labour market data really suggests that the RBA doesn't need to be any rush to deliver that next step of easing, but that picture could well change, particularly, of course, as we've just kicked off that election campaign, which Shery, as we know, the sort of, fiscal side and perhaps some of the tax cuts in the budget may sort of play through as well. So retail sales not really changing the picture too much there.
And we do have more breaking news when it comes to PMI numbers across Asia. Haidi, we are getting the Jibun Bank Japan PMI manufacturing, the final data for March, 48.4, so broadly in line with estimates. When it comes to South Korea, again in contraction territory, 49.1, and softening a little bit more from the previous month. What's interesting is Taiwan right now, because it's now fallen into that contraction territory for the first time since March of last year. So we're seeing these very export-dependent economies now seeing some of that PMI data softening in the past few months. Take a look at how Japanese assets are trading at the moment, because we're seeing a little bit of a rebound when it comes to the Nikkei after falling into correction territory. The topics also gaining about 1%. The Japanese yen holding steady at that 149, 150 level. All this as we had eco data earlier today, including the jobless rate coming in at 2.4%, a tight labor market that was lower than economists had expected. We also had the Tankan business survey as well, showing the large manufacturers remained pretty upbeat about business conditions. For more, let's bring in Bloomberg News senior editor Brian Fowler here with me. Brian, but still, the Tankan large manufacturers number was still slightly softer than the previous quarter.
Yeah, Shery. So the main figure came down a little bit as expected, but other parts of the report were actually much better than we thought. So the corresponding figure for service companies actually unexpectedly advanced, and the numbers for the small companies held up much more robustly than we expected. One thing I want to point out is inflation expectations for 5 years out edged up to 2.3% from 2.2. That 2.3% is the highest we've had since on record going back to 2014, and it shows that Japanese companies expect inflation to stay above the BOJ's target for another 5 more years. So it's pretty much a positive report for the BOJ.
Could we see that potentially being reflected on their activities, including hiring more people, and lead to more wage growth? I mean, we have seen the jobless numbers, pretty tight labor market still.
Yeah, so the jobless numbers, the jobless rate shows that the labor market remains tight, and in the Tankan, there's a gauge for labor conditions, and it's a terrible -37, which shows how difficult it is for companies to retain and attract new staff. So that's definitely going to keep upward pressure on wages, and I think that could feed into more demand and demand-led price gains that the BOJ has been looking for its virtuous cycle.
Has the positive sentiment readings been perhaps a little bit surprising, given the sort of imminent pressure and uncertainty from tariffs? Are we seeing the concerns about that materialize?
Yeah, so that's a great question, Heidi. I mean, the survey was taken between February 26th and March 31st. Typically, the results will come in about halfway through that period. So most of these companies will have reported before we really got the full story on tariffs. Obviously, reciprocal tariffs are still coming over the next couple days, but even the auto tariffs with auto parts included, most of the companies wouldn't have seen that yet. So we think the report doesn't fully reflect the impact of the tariff campaign. But, of course, they will have known that something was coming. So it's partially factored in, I think.
Yeah, Bloomberg's Brian Fowler here with the latest on economic data out of Japan. Of course, those tariffs expected to hurt a lot of automakers, also a lot of chip makers. Take a look at how Asian chip stocks are trading at the moment, because we have had news that Global Foundries is exploring a potential merger with Taiwan's United Microelectronics. This would be part of a long-shot deal aimed at creating a more resilient manufacturer of older generation semiconductors. Right now, a little bit of a mixed picture, especially here in Japan, with Advantis falling. But at the same time, we're seeing a broader rebound across markets in Asia after Japan already fell into correction territory. Heidi.
Yeah, and that is also why we're kind of seeing that correlated breather when it comes to the popular bond trade, right? They've been such a standout play as the tariff war, the trade war concerns really heat up. But you're seeing a little bit more volatility there at the moment as we've seen bonds fall, treasuries pairing those gains in the overnight session, that haven bid just retreating a bit as we kind of tread water. But we're also seeing that reflected in the likes of Australian sovereign bonds as well, that opened up lower on RBA decision day, watching JGBs as well. But of course, part of this move also came through from the move that we saw in European bond yields, with the sort of uncertainty over what the ECB might be looking at for that decision in just a couple of weeks' time. More ECB officials appear ready to be accepting a pause in April, and that bond yield move really passed through to markets like treasuries as well. Well, Morgan Stanley's chief US equity strategist thinks that investors should brace for even more disruption from the White House. Mike Wilson told us President Trump's policy changes so far have all been growth negative.
Everybody's looking for like a final piece here. This is gonna take time, and not unlike a lot of the other policies that have come out this year. Like this is what we kind of signed up for, right? I don't think what the president has done has really been surprising. All of the policy changes so far have been growth negative, and that, we've likened this to a new CEO coming in, right? They want to restructure the company. They're restructuring the company. They're going to kitchen sink it, and then they're going to try to make their plan work for next year. So this is going to take some time, and this level that we're at now is critical from a market standpoint, not so much from the administration standpoint. I think that's also something to acknowledge.
It's also very on brand for Trump to take a maximalist approach in the very beginning, but how messy could it be if he comes in with this maximalist, aggressive approach, and then we have retaliation from trading partners?
Well, look, it's the NAFTA, sort of like, it's the best alternative to a negotiated agreement, and the BATNA, and that is classic negotiating tactic. You come in and way over here to the right with the hope of kind of settling in the middle. So I don't think that's unusual either. The response from trade partners is that means they're engaging. Okay, so that's how you get people to engage in your discussion. You come out with a big splash. They have to come to the table and negotiations begin. We're not even at the table yet. Okay, so that's why this is going to be very uncertain for a period of time.
I think some countries think that they are at the table because they sent a few representatives here the past few weeks, but I agree with you. It really hasn't started. So what do you do if you're an investor? Well,
you've done what we've sort of done. You avoid the areas that are going to be most affected. Consumer discretionary goods, and that area has been hit the hardest, so maybe that's getting a little bit extreme. I would say, defensively positioned, high quality, that's been our core portfolio. Now, we've made some trading calls lately that would have gone against that. Some of those worked, some of those didn't work. But I think at this point, you want to be up the quality curve. You want to be in businesses that can kind of mitigate some of these concerns. You have pricing power. You have the ability to kind of move production around. You can take inventory on to kind of buffer this for 60 or 90 days, which we've seen all of those mitigation strategies, something we wrote about in our note today. So those are the kind of companies we want to own in this period of time. I do believe there will be a clearing event at some point this year, but we're not there yet.
Morgan Stanley Chief U.S. Equity Strategist Mike Wilson speaking with Bloomberg Surveillance. And these are some of the other market calls that we're following today as well. Goldman Sachs' David Kostin is cutting his S&P 500 target for a second time this month due to increased recession risk and tariff-related uncertainty. He expects the benchmark to end the year around 5,700 points versus his previous estimate of 6,200. Kostin warns that valuations could decline further if the growth outlook and investor confidence get worse.
Wells Fargo, Shery, predicting that the US dollar will be a market winner due to Trump's trade war. Its currency strategists expect the dollar to rise between 1.5% and 11%, depending on the level of US tariffs and other countries' responses. The predicted rise is due to weakened demand for overseas goods and the Fed keeping rates elevated. More ahead on the Asia trade. This is Bloomberg. Australia's central bank is expected today to keep interest rates unchanged, waiting out an election campaign and to assess the economic impact of Trump's tariffs. Let's bring our Bloomberg economy reporter, Swati Pandey. So there's a lot going on in Australia. Of course, kicking off the election campaign, there's an RBA decision, both internal and external risks potentially playing out here.
Yes, it's quite an interesting time. I mean, even though we are saying the RBA is not going to do anything, it's going to have a lot of discussion internally about all of these uncertainties as well. And because it is a closely fought election campaign, economists are also worrying about more election spending. We also had budget earlier in March, and that had more tax cuts and more sweeteners. So that is definitely a concern. And then there's tariffs from US. We don't know what's going to be, what it would mean for Australia yet. So yes, lots for the RBA to think about.
There doesn't seem to be, at this point, any rush, right? Do we expect the picture to be a little bit clearer by the time we get to May?
Yes, that's what the market's expecting as well. So we are seeing about an 80% pricing for a rate cut in May. And by then, the election would be over. We would know whether it's a minority government or majority government, what's the composition. We'd probably know what impact the tariffs likely to happen, and the RBA will get a comprehensive first quarter inflation report as well, and it will get its staff forecasts. So it will have a lot more information to decide whether it wants to cut again or not.
I know the tariff uncertainty is pretty high at the moment, but what are the guesstimates at this point when it comes to the economic outlook for Australia, depending on the tariff risk?
So the broader view is that Australia will not get the brunt of it. Treasurer Jim Chalmers has said that tariffs are self-defeating, and Australia is unlikely to slap reciprocal tariffs on the U.S. We also don't run deficits with the U.S., so it probably looks like we will be exempted. If we are not exempted, the tariff that we have on our goods will not be significant. However, Australia is a small open economy. We are very export reliant. We are extremely dependent on China. So if the world economy slows significantly, if China slows significantly, if commodity prices fall significantly, all of that is going to have an impact on Australia's economy.
Bloomberg's Swati Pandey there. Well, joining us now is Kate Harrison-Brennan, who's a director of the Sydney Policy Lab at the University of Sydney. She was also previously an advisor to the former Prime Minister Julia Gillard. Kate, really great to have you with us. And sort of as we get into the early stages of this election campaign, we're seeing a little bit of an uptick when it comes to polling support for the Prime Minister. It is looking relatively close. Do you see the leaders at this point sort of addressing the crux of what voters want to hear?
That's right, Heidi. It is a bit of a line ball at the moment. Leaders are very close. There's some interesting polling out that's looking at some of the finer points of how their leadership is being received by the Australian public, that looks at things like, would someone like to have a beer with them in the pub? But obviously a key concern in this election campaign is whether voters feel like they're being listened to. And I think that's really going to drive the way that they're campaigning in the weeks to come.
We've been talking about sort of the various forces at play here, obviously the internal sort of issues with the cost of living crisis, but that's also going to be affected by the external issues, which is the trade and broader alliance concerns over the US and the Trump administration on the other side, the increasing sort of assertion by Beijing as well. Do you think either Albanese or Dutton are sort of addressing these bigger geosecurity concerns?
I think this is the key reality for the Australian election, that while leaders are out campaigning, visiting many seats over the coming weeks, the media is still giving top billing to what's happening in the US or, as you said, in China. And so that becomes the soundtrack to which the election campaign is being played out. Voters at the same time want to know that their concerns with cost of living, how that's actually experienced, is being understood. And for people, that comes down to, you know, is that fear that when they get to the supermarket checkout that they can't pay for the contents of their trolley. Is that really being understood, or are only Band-Aid solutions being offered? So both major political parties are needing to find solutions that speak to voters' concerns. And I think there's still a sense that this generalised distress that people feel is not fully appreciated by political parties. You know, there is a reality for people that we've had a change from really, you know, a wage economy in Australia to an asset economy that's driving a wedge between the haves and have-nots. And we're not yet really seeing policies that address the reality of that.
Yeah, it's really interesting because just a few years ago, we saw Labor returning to power, pushing issues such as climate action, not to mention Indigenous rights. How are these other issues being superseded now by the cost of living crisis that Australians are feeling?
Yes, I think the cost of living crisis is playing out on top of a real change in the nature of equality and inequality in Australia. So where once it was a wage economy, now it is an asset economy. So merely looking at cost of living is not enough to understand what is being experienced by people. If we think about inflation in Australia, it's being driven to a large degree by housing undersupply, but people are experiencing that in terms of housing insecurity. And so that's why housing gets bound up so much with cost of living discussion in Australia. And ultimately, Australians want to know, how is that being engaged with by politicians? And is there really a future-looking proposition? Is there a case for a second term for an Albanese government or a change in government?
In the budget released last week, we saw Treasurer Chalmers announcing surprise tax cuts for every voter. How are these issues going to play into the minds of voters?
I think tax cuts are always very popular, and it's really the advantage of an incumbent government to use a budget so closely timed with the announcement of election to provide a springboard into an election campaign. In a sense, in Australia, we've had a shadow election campaign since Australia Day. That's the end of January. It was an announcement effectively in a campaign period, and it tends to play very well. At the same time, people want to know that care is going to be there when their ageing parents need it, that there is a reliable healthcare system, and hence this race to match commitments around protection of Medicare and bulk billing of doctors, and really a concern about what is the future of the country. And interestingly there, Labor is making a play of connecting the left of politics with a new form of patriotism, talking about the Australian way. So again, that's a connection to I guess an understanding for people that geopolitical tensions are looming large, and I think there's an understanding that the Australian public want to hear that this is being engaged with, and the time is there to speak to it and to shape up this sense of an Australian way.
Do you think that will be effective here? Because we've seen that, basically account for the perhaps unexpected revival of the Liberal Party, big L Liberal Party in Canada, for example. We've seen that in a number of other global elections.
I think the timing of the election, that it was necessarily delayed because of Cyclone Alfred, has given both political parties an opportunity to think about how they want to respond to President Trump, and has given a new appreciation to voters of what might be effective for Australia and our engagement with our ally. And so, for voters, they want to see that a nuanced approach, it seems, is playing quite well with voters, that there'd be a considered approach by a Prime Minister. And that's reflected, I think, in some of the polling we discussed earlier.
I wanted to get your view on the power of the Teals this time, right? Arguably even more powerful. Do you expect them to be kingmakers this time? And also, given that a lot of their traction is obviously in inner city seats with inner city metropolitan issues, can they repeat that influence, when it comes to more of the suburban and rural areas?
It's obviously decisive in Australia of how the composition of government will come up. So the Teals, obviously, as part of potential crossbench, have the ability to help a major party form government. And we've seen in the past how the days following an election can become very decisive in that. One major factor for the Teals in this election is that they're no longer able to draw a sharp contrast with Scott Morrison as Prime Minister. And so that will be interesting to see how does their proposition to voters shape up in a changed context. But still, their promises around reflecting community values and community voice are very appealing to voters who want to know that their voice will be heard and represented in Canberra.
Kate, really great to have you with us. Kate Harrison-Brennan, who's a director of the Sydney Policy Lab at the University of Sydney. We do have more on Australia Ahead. That's every Tuesday at 11:40am if you're watching here in Sydney, 8:40am if you're joining us in Hong Kong. Plus, you can tune into the Bloomberg Australia podcast, delving into the biggest stories shaping the country's role in global business. You can find that on Apple, Spotify or Bloomberg.com. More ahead on the Asia Trade. This is Bloomberg. Emerging market stocks holding steady after 3 sessions of losses already. Of course, we had seen this anticipation over reciprocal tariffs coming from the U.S. Taiwan stocks really weighing heavily on the emerging market stocks in the previous session, given that they fell into correction territory. Perhaps really not surprising, given that even their PMI numbers that we just got a few minutes ago fell into contraction territory. All of this to do with, of course, the risks around exports, the risks around
around automakers, semiconductors, just the tech sector really being vulnerable to these tariffs. With President Trump saying that he's not necessarily worried that tariffs will push allies toward China, but still we're seeing the impact in emerging markets. You can see the currency space also holding steady for EM currencies. And also the caveat being that when it comes to the first quarter, though, Haidi, we did see resilience in emerging market assets. They actually finished the quarter with gains for stocks as well as for the currency index.
Take a look, Shery, at how we're shaping up when it comes to US futures as this market gets sort of a little bit of respite, if you will, from these tariff nerves. But of course, as we approach, as President Trump has called it, Liberation Day, we're expecting sort of that revival of volatility, of course. We are seeing Asian shares rising after that 4-day drop on tariffs. And this is the picture when it comes to markets that are opening in the next hour or so. TAIEX futures, of course, after Taiwan stocks enter correction territory, looking like we'll see a pickup of about 0.6%. FTSE A50 China futures looking modestly positive as well, but not so great that S&P futures after that brief rebound in the overnight session, looking like we'll see some downwards trading as we get into Liberation Day this week with the April 2nd reciprocal tariffs to be announced there. Watching Taiwan especially today because we have seen that cashing out from foreign investors at a pretty frenetic pace. That is it for the Asia trade. Our markets coverage continues with the start of trading in Hong Kong, Shanghai and Shenzhen. The China show is next. This is Bloomberg.